Alright traders, Shane from Global Market Trader. I thought I would spend a little bit of time with you today just taking you through how to trade the MACD and provide a bit more information on how to use the MACD as an indicator to spot high probability trading opportunities. So let's jump in and start having a look at the MACD. Alright, so what is the MACD? It's a moving average convergence divergence indicator. So what we're going to do today is look at how we can benefit from using the MACD as an indicator. So let's have a look at some of the benefits of using the MACD. Well, for a start, the MACD really gives us an indication of what's happening with the momentum of the market that we're trading. So it's not only looking at momentum, but it's also a good trend indicator. So it's got that positive feature of being an oscillator, but also allows us to identify and determine the market trend. Alright traders, let's have a look at the components of the indicator. MACD. So the MACD line consists of taking a 12-period exponential moving average, then subtracting a 26-period exponential moving average, and this line then forms the basis of the MACD. So that line is then plotted below the price chart with the center line at 0. What we see then is a signal line, which is a 9-period exponential moving average. Now to MACD histogram to our indicator set, and that is created by subtracting the signal line from the MACD line, and that is represented as a histogram. So let's have a look at how that looks on our charts. Let's now have a look at the MACD on our chart. So as you can see, the top area of our chart is our price action, which is reflected in Renko bars. So that's just showing you what's happening with price. There you can see price moving up, a little bit of consolidation, then a run back up again, and then we've got that run down. Now below our price chart is basically a picture of the MACD. So we have the MACD line, which is our yellow solid line. We have our signal line, which is our 9 exponential moving average, and we also have our 0 line, and our histogram is reflected on there as well. When the MACD line is trading above the 0 line, it's telling us that the 12-period exponential moving average is trading above the 26-period exponential moving average. When the MACD line is below the 0 line, it's telling us that the period exponential moving average is below the 26-period exponential moving average. In its simplest form, the MACD is an easier way for us really to identify a moving average crossover system, because remembering that the MACD is actually derived from two moving averages. What we're looking for is when the MACD is above the 0 line, it's giving us an indication that there is rising bullish momentum, and that the gap between the 12 and 26 period moving average is widening. And conversely, when we see the MACD fall below the 0 line, we're seeing falling bearish momentum, and that's telling us that the gap between the 12 period and 26 period moving average is widening, and we're getting bearish momentum. From this picture that the rising bullish momentum is reflected in price action, and we also see that as the MACD comes down, we see price action come off as well. So that's reflected in price action with the MACD falling below the 0 line and price continuing to run down. Let's have a look at our MACD crossing above and below the 0 line now. So we see here that the MACD starts to make its way above the 0 line and crosses there at 20.04, and you can see that picks up that bullish run on price action, and then we see price starting to come off, and we see a cross here at 9 o'clock, and price starts to come off. Now it doesn't automatically trade lower, so we see price coming off there, and that does pick up a nice push down as well. So just picking the turns in momentum nicely, and just the cross of the 0 line, just showing you that the MACD is reflecting what price action is doing. Traders, the purpose of the 9-period exponential moving average is really used as a confirmation tool. So we see a cross here on the MACD above the signal line, which confirms bullish momentum, and then up here we see a little bit of a cross, or a cross below the signal line, which gives us a potential sell setup. Now, one thing you've got to be a little bit careful of using the MACD cross above and below the 9-period exponential moving average is that if you just trade this signal on its own, it can get you into a lot of choppy trades, so it needs to be used with other filters, and we'll talk to you a little bit more about that in part 2 of our video, because you can see here that the initial cross didn't work, but the secondary one did. We had price making higher highs, so we had price pushing up, and then we had our MACD coming off, so that was a nice secondary sell set up there on a cross of the 9-period exponential moving average. But we'll talk a little bit about that in video 2 or part 2 of our video series. So that is a very quick look at the MACD and the basics of the MACD. Now we're going to go into our next video and look at how we potentially are going to trade the MACD and how we can use it to identify high probability setups. Now before we do that, we haven't talked much about the histogram. So really the histogram is giving you a look at the difference between, just a reflection of the distance between the MACD and the signal line, and that's reflected in these vertical bars both above the zero line, and then we have vertical bars below as price starts to move down. Simplest, what we can derive from the MACD is that when the MACD histogram is above the zero line, it's telling us that positive momentum is increasing, and conversely, when it's below the zero line, it's telling us that that bearish momentum is starting to increase. We should really have a reasonably good understanding now of how the MACD works, and in our next video we're going to start to put those pieces together to look at high probability setups on our chart. So thank you for your time, everybody, and we'll catch you for part 2 of trading the MACD.